Welcome to the Estate Blueprint, Planning Your Future with Tom Begley.
Hey everyone, welcome into an all-new episode of the Estate Blueprint with attorney Tom D. Begley, the founder of Tom D. Begley III LLC out there in Morristown, New Jersey. I'm your host, Mike Leon. Tom here is a certified elder law attorney. He's got more than 35 years of experience helping South Jersey families protect what they've worked hard for, through estate planning, special needs trust, Medicaid planning, and probate administration. And in today's episode, we're going to be covering the inheritance tax. Tom's going to explain, hey, who pays for this, when it applies, and how smart planning can help reduce it. Tom, it's good to see you. I'm sure a lot of your clients are surprised to learn, or maybe they aren't surprised to learn that New Jersey still has an inheritance tax. How is that different, though, than the estate tax that was repealed a few years ago by the state?
Well, yeah, Mike, it's different because the estate tax is a tax on the estate itself. The estate tax is an assessment on someone's assets when they pass away, and it doesn't matter who they're going to. The inheritance tax, by contrast, is a tax on the heirs, and that tax is calculated based on the amount that's being left to an individual times the amount that their particular class is supposed to be taxed at in the four classifications. In New Jersey, we don't have an estate tax anymore. As you noted, that went away on January 1st, 2018, and I don't think that's coming back anytime soon. The federal estate tax is the only estate tax which is left that applies to residents of the state of New Jersey. However, you need to have more than $13,980,000 to have that tax assessed upon you. And frankly, there's not too many people that have to worry about that particular problem. So in New Jersey, there is an estate tax that's gone bye-bye. We do have the inheritance tax that does affect a number of people, however.
Tom, so you mentioned the heirs have to pay this. So does it depend on how close you were to the person who passed away? Like who are some of those heirs that have to pay this inheritance tax?
Yeah, so basically the New Jersey inheritance tax has four classifications or four classes. There's Class A, C, D, and E. Class B basically was one that was repealed back in the early 1980s. So most people actually don't have to pay the inheritance tax. Most people fall under what's called Class A. And Class A is parents, spouses, children, including stepchildren, grandchildren, and other lineal descendants. They're all considered Class A, and the tax rate for them is zero. The other class that doesn't have to pay any inheritance tax is charities, and only because a government legislator could be the only person that would come up with this idea. In that particular part of the administrative code, it says that the government itself does not charge a tax if you leave it money. Crazy, right? So there are two classes of people that do have to pay a tax. One is Class C, and that's a very narrow class. And that is brothers, sisters, sons-in-laws, and daughters-in-laws. And then the other class that does pay is Class D, and that is more remote family members, friends, and other individuals. So really, it's Class C, Class D, the two classifications that are subject to inheritance tax in the state of New Jersey.
So are nieces and nephews, those type of relatives, are they exempt or they still owe the tax?
They're not. So nieces and nephews come into that Class D. So they're part of the Class D beneficiary. Anybody except for spouses, children, grandchildren, parents, spouses, they're all Class A. Everybody else has to pay a tax. It's an individual. It's just the rates that people will have to pay the tax are different. So Class C is basically brothers, sisters, sons-in-laws, daughters-in-law. Each of them has a $25,000 exemption from paying the tax. And then the tax is assessed at rates which range from 11% up to 16%. Every other person is classified as Class D. They pay effectively 15% for the first $700,000 received, and then they have 16% for the amount which exceeds that. Except only because only in New Jersey would somebody write a law like this. There's actually a $499 exemption from inheritance tax. So, Mike, if I were to put inside my will that I leave my dear friend Mike Leon $499, you get $499. However, if I say that you get $500, the tax is retroactive to the first dollar, and instead of getting 500, you get 500 minus 75, or $425. So, I can't even imagine where somebody came up with that sort of notion. So for those of that's what we live with in the state of New Jersey. We're only one of the handful of states left with the inheritance tax, but I guess if we're going to be that embarrassing to have an inheritance tax, we should be embarrassing enough to have some crazy rules and regulations that surround it.
Well, I was hoping you would leave me more than $499. And I was going to ask you how to figure out the tax in practice. So I'm glad you gave the calculations. But let me ask you, so let's say a parent leaves their home or a bank account to one of these exempt or non-exempt heirs. What happens before the heir can actually sell or retitle it?
Okay, so if there's an exempt here, so let's say for example it's a husband and wife, and they leave money behind to their children. There's no tax, and in order to access the accounts, they have to fill out one of two particular forms. One is called a Form L9, and that's a form which is used to sell real estate, and the other is called a Form L8, which is used for financial assets such as bank accounts and brokerage accounts. And those are very, very simple. They get processed very easily. As a matter of fact, for the financial accounts, you merely go to the bank or the brokerage house. Once you fill out the application, that institution in turn files with the state, and they can release the assets to you immediately. As far as the real estate is concerned, you can actually sell it as soon as somebody qualifies to become the executor or the administrator of the estate. The only issue is that if you don't have what's called a tax waiver, which you get from filing Form L9 with the state, then the title company that's handling the transaction to sell the real estate may hold a portion of the net proceeds in escrow until that waiver comes in. Now, if you're talking on the other hand about relatives or other individuals that may be subject to the inheritance tax, then you typically have to file what's known as a New Jersey transfer inheritance tax return. And when that form gets filed with the state, you have to wait for the form to be reviewed, potentially audited, and then the state will release what's called a notice of assessment. And it's a bit more of a complicated procedure. Now, you can certainly go ahead once again and sell the real estate. However, when you go to closing, the title insurance company that's handling the transaction is very, very most likely going to hold on to a portion of the net proceeds until that tax waiver is received. Likewise, when you go to financial institutions, they are typically going to go hold half of the account. So let's say, for example, using that friendly example, and since I'm going to give you more than $499, my dear friend, let's say my dear friend Mike Leon's going to get my bank account worth $500,000. They'll let you get 200. That's better for you, right?
Yep.
$250,000 is going to go to when you go to the bank, but they're going to hold the other $250,000 until that tax waiver is produced from the state. Okay.
That's a lot better of an amount there. But so let me ask you then, it funnels into the follow-up perfectly. Are there ways to plan ahead so that less of the inheritance goes to taxes? You just mentioned some examples there. You talked about the charity donations earlier. So are those the ways that you would plan ahead or advise people to plan ahead and so they don't have to pay as much?
Well, so as far as the inheritance tax, there's limitations what you can do as far as planning is concerned. There are certain things that you can know and can do. So one, for example, it's the only exception to the inheritance tax, and that is life insurance to the extent that it goes to a named beneficiary. Uh, the other time would be if you're doing gifts, and the gifts would have to be more in New Jersey than 3 years prior to date of death. Let me give you a good example of how planning can work in a case that involves inheritance tax. A number of years ago, probably about a dozen years ago, the best example that comes to mind, there was a lady, she was widowed, didn't have any children, and she had beneficiaries that fell into uh, two categories. She wanted to leave half to two nieces, and the other half she wanted to leave to 8 different charities. And the charities were all tax exempt 503 charities, 503C charities. Anyway, what happened was she had a life insurance policy worth $300,000. She had a series of retirement plans that was worth about $200,000, and then she had a home that was worth about $300,000. Just so we had about an $800,000 estate. So that would be $400,000 each of you divided 50-50. Now, what we did was we changed the insurance beneficiary to be the two nieces because they're exempt from the tax. So if you take 15% times 300,000, that's $45,000 that was saved from inheritance tax. Now, charities are exempt from the tax, but the great thing about charities is that they don't have to pay income tax. So it was great to leave the $200,000 to them because, in addition to the nieces having to pay inheritance tax if they had received any of that, they would have also had to pay the income tax. There's some misconception that you have to pay one or the other. Unfortunately, when it comes to the inheritance tax, you have to pay both. Now, when all's said and done, however, this particular client, she did want the estate to be divided 50-50. So one of the things that I came up with some years back was called an equalization clause. I came about it as a result of some litigation that involved people really taking assets that they should have held on to, which they managed during a lifetime. But what happened here was I said in the will, before making any distribution to any of the beneficiaries under the will, that the executor was to take into account any asset that that beneficiary received outside the will. So when we have an $800,000 estate, $300,000 went to the nieces, to the life insurance, $200,000 went to the charities because of the IRAs. So if we just didn't have that language in there and just said 50-50, the nieces would have gotten more than the charities. So what happened as a result of the equalization clause, once the house was sold, $100,000 went to the nieces, so the 300 plus the 100 equals 400,000. Then 200,000 from the sale of the house went to the charity. So everybody got their 400,000. I know this is a bit of an oversimplification, but in a nutshell, we saved a lot of inheritance tax, we saved a lot of income tax, and we made sure that everybody got treated the way that the client wanted them to be treated.
No, but it does funnel into another follow-up I just thought of, which is, there are probably more scenarios that could create an unexpected inheritance tax bill. What are some of those? Maybe joint bank accounts, maybe naming a friend as a beneficiary. Are there examples like that that could create this?
Well, there are some things that create unintentional taxes. So, one thing that you mentioned about was the joint accounts. Sometimes somebody will put down um, a trusted, I have one example that pops right to mind. I had a case several years back where a mom, she was widowed, had three daughters, and she wanted to make sure that if she ever needed to go into a nursing home, that all of her money would be spent on long-term care costs. So one of the ways that we could work and still work to minimize exposure to long-term care costs is to transfer assets. Now, with the Medicaid rules, which is probably time for another episode, we would transfer a portion of the assets out subject to the 5-year look back. Now, I set up things for a trust which avoids some of these problems, but historically, many people would transfer the assets to the three daughters to make sure that the money's there for mom during a lifetime if she needs it, that even though legally mom doesn't have a right to it, there's a pot that the daughters can use of what is technically their own money. And then when mom passes on, they really would just divide everything three ways. What happened in one particular occasion that I know of was that an attorney set up an account worth about $450,000, and basically there were three daughters that were on it. Now they were all Class A beneficiaries, so if mom had died, just left the $450,000 to them in the will, no problems whatsoever. But the money was gifted during a lifetime, which once again, between a parent and child, does not create an inheritance tax. But what happened was one of the daughters actually died before mom, and as a result, her $150,000 is what the state valued her portion of the account, not being subject to inheritance tax because as far as the account was set up, it had been set up with a right of survivorship. So her two sisters were going to be the beneficiaries. And as a result, the state said, well, there's $150,000. There's two sisters, so there's a $25,000 exemption each. But for that other $100,000, $11,000 had to go to our good friends in Trenton. And in the grand scheme of things, that's not the biggest amount that we've ever heard bandied about, but nobody wants to give Trenton $11,000 so they don't have to.
Right.
The other thing you talked about, interestingly enough, though, Mike, was about joint accounts. A lot of times if people have their kids on the account, that's not going to be a problem. But I've had occasion where somebody puts down like a niece or a nephew, and that sometimes will create an inheritance tax because in New Jersey, the presumption is that when somebody dies and there's a joint account, that the deceased person put everything into it, and the person who is the survivor is going to be subject to that inheritance tax. In Pennsylvania, actually, if you do it 1 year prior to death, they actually make it 50-50. So, but we're talking about New Jersey, and New Jersey is not particularly kind when it comes to that issue.
Well, again, another perfect follow up because you mentioned another state. So, what happens? We haven't talked about another state. What happens if someone lives in another state but they inherit it from a New Jersey resident? Does the New Jersey resident inheritance tax still apply?
Actually, Mike, that's a perfect question because a lot of people think that the inheritance tax is imposed upon the individual based on the state in which the heir resides. It's actually based solely on where the decedent resides. So if, I'm single and I don't have a wife and I don't have any kids, but I've got a bunch of nieces and nephews that live in 8 different states, it doesn't matter where they live. It's because I'm a resident of the state of New Jersey. That's where the tax is imposed.
Okay. Easiest answer there. All right. So then let me ask you, Tom, as we wind down on this episode, for families who haven't reviewed their plans in a while, what's the easiest way you would recommend for them right now to make sure that their documents are in order, their beneficiary choices won't surprise any loved ones, and they won't avoid these taxes to be paid on?
I mean, it's almost a rhetorical question. The best way, Mike, is to consult with somebody that knows what they're doing, that handles this particular area of law, and they should expect when they meet with an attorney that the individual first requests 2 forms of background information. One, I have an intake form, basically specifies what the individual wants and an outline of what their assets are worth. And secondly, to provide backup documentation. A lot of times people own assets and they forget that they have a joint account holder or they don't know who the beneficiaries are. One thing that we talked about earlier, for example, is that life insurance, if it goes to a named beneficiary, is exempt from inheritance tax. I've had a lot of times, however, where inheritance tax is paid because, in a case I get a lot from time to time, is there's a married couple and the wife has the husband as the beneficiary, but then he passes away. There's no backup beneficiary. She may have a will leaving everything to 4 nieces and nephews, and the insurance says it's worth $200,000. And if the $200,000 is paid directly to those beneficiaries, there's no tax whatsoever. But what happens is they never think about that backup beneficiary, and so it passes to the estate. When it passes to the estate, there's a $30,000 tax because it's 15% of the $200,000.
Right.
So it's very important to check and just don't take anybody's good word for what they think that they may or may not be worth and how things are held. And then that person that they meet with ought to really be able to go through in detail, what we've done this afternoon, and that's review the financial background and the goals and what the law is saying to see what exemptions that you can find and deductions that you can find to minimize the tax.
Tom, thank you for the time and insights on this. Truly appreciate it as always.
Okay, thanks, Mike, for having me.
And that's it for today's episode of the Estate Blueprint with attorney Tom D. Begley III. If you want to learn more about Tom's work in estate planning, elder law, special needs trust, do me a favor, visit Begley3law.com. You're going to find all the resources to help you protect your assets, care for loved ones, and plan with confidence. And as always, thanks for listening to this episode. Share it with someone who needs to hear it. Don't forget to like, subscribe, leave a review, and comment. As always, I'm Mike Leon. We'll see everybody next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.